For more on where the markets are heading, let's welcome Michael Bapis. He's Vios Advisors at Rockefeller Global Family Office. Good to see you again.
Good to see you. Thanks for having me.
Are you surprised at all by the reaction in the market today, knowing that all weekend we were, as of yesterday, really, with, the interview with President Trump around the Super Bowl, tariffs are coming today at some point?
Look, I think I'm not that surprised. It's funny because uncertainty always creates volatility, but it seems like we always have some component of uncertainty.
I thought the market hates uncertainty, though.
It does hate uncertainty, but here's the key. We're moving from a rotation from growth to value. There are companies that haven't moved in 2.5, 3 years that are starting to move and surprising earnings on the upside. So what we really try to focus on is earnings, companies, what's driving that. Tariffs may change the landscape for companies, but we're thinking they'll be nimble enough to advise all of their people to change along with the tariffs.
All right, so just as I said to Brian Levitt, who was sitting here, earnings greater than tariffs. That's what you're saying as well. That's the whole game. Even if we get tariffs and more come next week and the week after and after that.
Yeah.
As long as earnings hold up.
And interest rates and inflation. Those three components are crucial.
Well, couldn't inflation, be impacted by the tariffs?
Correct. It could. But I think earnings still, if earnings keep strong, inflation doesn't go too rampant, and rates are regulated in a way that they don't go up too much, but they come down a little bit. Where they are now, maybe 50 bips here or there, I think the earnings is the most important component to what we're doing.
Okay, so how much of that plays into your growth is moving to value?
A lot.
All of it?
A lot. Look, technology will always be here. We are in the middle of a 100-year technology boom that's unlike anything we've ever seen probably in history of humankind. Now, they have moved really fast, really far. You're seeing people rotate out of them because there's value in some of these other companies that are paying dividends. If you look at the financial sector, they surprised earnings on the upside in a dramatic way, and people still only want to talk about tariffs and Trump. So it's funny. At some point, managers will start to realize it. We'll all start to realize it, and that's where we're looking to invest a lot of our clients' assets.
You hit on something interesting. People want to talk about tariffs and Trump because what was expected to be a robust 2025 for deal making. I know we're only a month in or 6 weeks in, but we just had the slowest January in as far as a lot of people can remember.
Yeah.
In part because of the unknown coming out of D.C.
I think a lot of people sat on their hands. I think a lot of people were waiting to see what happened. I think a lot of people were, he only took office on the 20th, technically, even though he's been managing this for 2 months now.
Sure, but the market, gets ahead of everything.
Precedes the economy. I think the market's going to precede the economy by 6 to 9 months, as it always does. And again, the geopolitical landscape is always going to be turmoil there. And clients and advisors, we have to stick to focusing on earnings, focusing on what matters, focusing on asset allocation, and having an alternatives component to the asset allocation to help during volatile times on the fixed income and the equity markets. Alternatives really matter at this point. Low volatility, uncorrelated, low beta to public markets. We're advising our clients to be, 25 to 30% alternatives to assist in these volatile times.
Best part in that is what? Private equity, private credit?
Private equity, private credit, mostly private credit right now. There's so much money on the sidelines to still be put to work. People are just trying to figure out where to go. You're going to see M&A pick up in the next probably quarter or two, and that drives earnings, that drives markets higher because there's cash and because there's been no M&A or relatively no M&A for 2 years.
You don't feel like there's too much money going into private credit? I'm not trying to lead the witness here either.
At this point, no. At this point, private credit's a big component to alternative investments, market neutral portfolios where you're looking for arbitrage with a low volatility, even quality hedge funds, quality multi-strats where they're just not correlated to the markets, so that in the volatile times and while we wait for earnings to come in and while we wait to see where inflation really shakes out with these tariffs, you have a coupon that's coming in at a regular basis with a low volatility.
It's non-correlated, but also not as liquid.
Correct.
That's one of the issues.
That's a great point.
You have to be prepared for.
100%. Liquidity alternatives are limited on liquidity, but most of what we try to advise our clients on, again, is a long-term time perspective, long-term time horizon, 5, 7, 10 years, because in the short term, you will see volatility with everything that's going on.